Question 1. Title searches and examinations. When conducting a title search, a title examiner discovers that a property was previously owned by a deceased individual whose will was never probated. What is the most appropriate course of action for the title examiner to take in this situation? A. Issue the title insurance policy with a standard exception for unprobated wills. B. Perform a quiet title action to clear any potential claims from the deceased's estate. C. Exclude the property from the title insurance policy until the will is probated. D. Request a statement from the heirs of the deceased regarding their claim to the property. Answer. B. Perform a quiet title action to clear any potential claims from the deceased's estate. Explanation. In Indiana, if a property was previously owned by a deceased individual whose will was never probated, there may be unresolved claims from the deceased's estate. The title examiner should initiate a quiet title action to resolve any potential claims and clear the title of any disputes related to the deceased's estate. A quiet title action is a legal proceeding to establish clear ownership and remove any claims or defects on the title. Simply issuing a policy with an exception or waiting for a statement from heirs does not address the underlying issue of potential claims from the estate. Question 2. Title insurance policies. Which of the following accurately describes a key difference between a standard title insurance policy and an extended coverage policy? A. A standard policy covers only basic title defects such as forgery and fraud, while an extended policy covers additional risks including zoning violations and unrecorded liens. B. A standard policy covers all risks associated with the title as long as they are not specifically excluded, whereas an extended policy provides coverage only for risks identified in the title report. C. An extended policy provides coverage for defects that occur after the date of the policy issuance, while a standard policy only covers defects existing at the time of issuance. D. A standard policy offers more comprehensive protection against boundary disputes than an extended policy. Answer A. A standard policy covers only basic title defects such as forgery and fraud, while an extended policy covers additional risks including zoning violations and unrecorded liens. Explanation. A standard title insurance policy typically provides coverage for fundamental title defects, such as forgery, fraud, and other issues affecting the title that existed before the policy was issued. An extended coverage policy, however, offers broader protection, including coverage for risks not covered by a standard policy such as zoning violations, unrecorded liens, and certain boundary disputes. The other options either misrepresent the nature of coverage or incorrectly describe the scope of the policies. Question 3. Scenario-based question. Mr. Smith is in the process of purchasing a commercial property. During the title search, the title examiner discovers a recorded easement on the property that was granted to a neighboring landowner for access to a shared road. The easement is not mentioned in the title commitment Schedule B. What should Mr. Smith do to ensure that his property purchase is not adversely affected by the easement? A. Proceed with the purchase and address the easement issue after closing by negotiating with the neighboring landowner. B. Request a title endorsement that provides coverage for the easement to be included in the final policy. C. Ask the title examiner to remove the easement from the title commitment before proceeding with the purchase. D. Cancel the purchase agreement as the existence of the easement makes the property undesirable. Answer. B. Request a title endorsement that provides coverage for the easement to be included in the final policy. Explanation. In real estate transactions, if an easement is discovered that was not included in the initial title commitment, it is crucial to address it to protect the buyer's interests. Mr. Smith should request a title endorsement that provides coverage for the easement. This ensures that any issues arising from the easement are covered by the title insurance policy. Simply proceeding with the purchase or negotiating after closing may not adequately protect Mr. Smith from potential disputes related to the easement. Removing the easement from the title commitment is not possible if it is a recorded and valid easement, and cancelling the purchase may not be necessary if proper coverage is obtained. Question 4. Real property law and legal concepts. What is the primary legal distinction between fee simple absolute and fee simple determinable ownership in real property? A. Fee simple absolute ownership is conditional upon certain events, while fee simple determinable ownership is perpetual and unconditional. B. Fee simple determinable ownership includes a right of reversion if a condition is violated, whereas fee simple absolute ownership does not include such a condition. C. Fee simple absolute ownership allows for limitations on the use of the property, while fee simple determinable ownership grants absolute control with no restrictions. D. Fee simple determinable ownership is transferable, but fee simple absolute ownership is not transferable. Answer. B. Fee simple determinable ownership includes a right of reversion if a condition is violated, whereas fee simple absolute ownership does not include such a condition. Explanation: fee simple absolute is the most complete form of property ownership with no conditions attached and the right to transfer the property freely. In contrast, fee simple determinable ownership includes a condition or limitation. If this condition is breached, the property automatically reverts to the original grantor or their heirs. This distinction is fundamental in understanding property rights and the potential for future interests in real property. Question 5. Title searches and examinations. What is the purpose of an abstract of title and how does it differ from a title report? A. An abstract of title summarizes only the most recent transactions, while a title report includes a comprehensive history of all recorded transactions affecting the property. B. An abstract of title provides a detailed summary of the property's ownership history, whereas a title report is a formal document that provides a current snapshot of the title status. C. An abstract of title is prepared by the title insurance underwriter, while a title report is prepared by the buyer's attorney. D. An abstract of title is only used for residential properties, whereas a title report is used for commercial properties. Answer: B. An abstract of title provides a detailed summary of the property's ownership history, whereas a title report is a formal document that provides a current snapshot of the title status. Explanation: an abstract of title is a comprehensive summary of the property's ownership history and legal encumbrances, providing a historical overview that can be used to identify potential issues. In contrast, a title report is a formal document issued by a title insurance company that reflects the current status of the title, including any issues or exceptions that need to be addressed before issuing a title policy. The abstract is used for historical review, while the title report provides up-to-date information. Question 6. Title insurance policies. Which type of title insurance endorsement would a buyer most likely request if they are concerned about potential zoning issues that were not identified in the title commitment? A. Environmental protection endorsement. B. Zoning endorsement. C. Survey endorsement. D. Construction endorsement. Answer: B. Zoning endorsement. Explanation: a zoning endorsement provides coverage for risks related to zoning issues, such as violations of zoning laws or restrictions that were not disclosed in the title commitment. This endorsement is crucial for buyers who want protection against potential zoning disputes that could affect the use or value of the property. The other endorsements listed do not specifically address zoning issues and would not provide the necessary coverage for this concern. Question 7. Title insurance underwriting. When assessing risk in title insurance underwriting, what is the significance of evaluating the legal description of the property? A. It determines the property's market value for insurance purposes. B. It ensures that the property is correctly identified and that there are no discrepancies or encumbrances affecting the coverage. C. It assesses the environmental risks associated with the property. D. It establishes the proper insurance premium rate for the policy. Answer: B. It ensures that the property is correctly identified and that there are no discrepancies or encumbrances affecting the coverage. Explanation: the legal description of a property is crucial in title insurance underwriting as it precisely identifies the boundaries and location of the property. Ensuring the accuracy of the legal description helps prevent discrepancies or encumbrances that could affect the title and the insurance coverage. It does not directly affect the market value, environmental risks, or insurance premium rate, but it is fundamental for determining the correctness of the title and the scope of coverage. Question 8. Title insurance regulations and compliance. Under the Real Estate Settlement Procedures Act, RESPA, what is the primary purpose of the good faith estimate (GAE) provided to borrowers? A. To outline the lender's terms and conditions for the loan. B. To provide an estimate of the costs and fees associated with the real estate settlement process. C. To disclose the insurance coverage provided by the title insurance policy. D. To detail the legal description of the property being purchased. Answer: B. To provide an estimate of the costs and fees associated with the real estate settlement process. Explanation: under RESPA, the good faith estimate (GAE) is intended to provide borrowers with an estimate of the costs and fees associated with the real estate settlement process. This allows borrowers to understand the potential costs before finalizing the loan and helps ensure transparency in the settlement process. The GFE does not outline loan terms, insurance coverage, or legal descriptions of the property. Question 9. Ethics and professional responsibility. What is a key ethical consideration for title insurance professionals when dealing with confidential information? A. Disclosing confidential information to competing title companies to compare services. B. Ensuring that all confidential information is shared only with authorized parties involved in the transaction. C. Using confidential information to gain personal advantage in future transactions. D. Retaining confidential information indefinitely even after the transaction is complete. Answer: B. Ensuring that all confidential information is shared only with authorized parties involved in the transaction. Explanation: Title insurance professionals have an ethical obligation to protect confidential information and only share it with authorized parties involved in the transaction. This ensures that sensitive information is handled responsibly and maintains trust in the professional's integrity. Disclosing information to competitors, using it for personal gain, or retaining it indefinitely violates ethical standards and privacy laws. Question 10. Closing and settlement procedures. During the closing process, what role does the closing protection letter (CPL) play in protecting the parties involved? A. It provides a detailed accounting of all settlement funds and disbursements. B. It guarantees that the title insurance policy will cover any losses due to fraud or misappropriation by the closing agent. C. It outlines the legal obligations of the buyer and seller in the closing process. D. It serves as a formal document recording the transfer of property ownership. Answer: B. It guarantees that the title insurance policy will cover any losses due to fraud or misappropriation by the closing agent. Explanation: The closing protection letter (CPL) provides protection to the parties involved in a real estate transaction by guaranteeing coverage for any losses resulting from fraud or misappropriation of funds by the closing agent. It does not provide a detailed accounting of funds, outline legal obligations, or serve as a transfer document. The CPL is essential for ensuring that parties are protected against potential misconduct during the closing process. Question 11. Title searches and examinations. In reviewing a chain of title, a title examiner finds a break in the chain due to an unrecorded deed from 20 years ago. What is the most appropriate action to resolve this issue? A. Ignore the unrecorded deed and proceed with issuing the title policy as it does not affect current ownership. B. Attempt to locate the original parties to the unrecorded deed to obtain an affidavit confirming the transaction. C. Conduct a title search back to the earliest recorded document and attempt to re-establish the chain of title. D. Require the current owner to obtain a quitclaim deed from the parties involved in the unrecorded deed. Answer: C. Conduct a title search back to the earliest recorded document and attempt to re-establish the chain of title. Explanation: A break in the chain of title due to an unrecorded deed presents a significant issue as it can cast doubt on the current owner's title. The best approach is to conduct a comprehensive title search back to the earliest recorded documents to identify and resolve any gaps. This may involve re-establishing the chain of title by locating relevant documentation or legal actions to correct the title. Ignoring the issue or relying solely on affidavits does not address the underlying problem and may leave unresolved claims. Question 12. Real property law and legal concepts. What is the legal effect of a mechanic's lien filed against a property, and how does it affect the title? A. A mechanic's lien ensures priority over all other liens and encumbrances on the property. B. A mechanic's lien attaches to the property and may take precedence over other claims if not resolved before the sale. C. A mechanic's lien is automatically removed if the property is sold to a new owner. D. A mechanic's lien does not affect the title and is merely a record of unpaid work. Answer: B. A mechanic's lien attaches to the property and may take precedence over other claims if not resolved before the sale. Explanation: A mechanic's lien is a legal claim against a property for unpaid labor or materials used in improvements. It attaches to the property and can affect the title by potentially taking precedence over other claims if not addressed before a sale. Unlike other types of liens, mechanic's liens can have a significant impact on the property's marketability and may need to be resolved before closing. It does not automatically get removed upon sale and does affect the title. Question 13. Title insurance policies. What is a key feature of an ALTA, American Land Title Association policy compared to a standard title insurance policy? A ALTA policy provides coverage for all potential defects regardless of their nature. B. An ALTA policy includes additional coverage for matters that are not typically covered by standard policies, such as certain zoning issues and survey matters. C. A LTA policy is only available for commercial properties and not for residential transactions. D. An ALTA policy offers no additional protection beyond what is provided in a standard policy. Answer B. An ALTA policy includes additional coverage for matters that are not typically covered by standard policies, such as certain zoning issues and survey matters. Explanation. An ALTA policy, particularly the ALTA 2006 or ALTA 2016 policies, offers enhanced coverage compared to standard title insurance policies. It includes additional protection for issues such as zoning violations, survey matters, and other risks that might not be covered under a standard policy. This makes ALTA policies more comprehensive and suitable for transactions involving complex properties or additional risk factors. Question 14. Title insurance underwriting. When underwriting title insurance for a commercial property, what is an important factor to consider that differs from underwriting residential properties? A. The commercial property's location relative to public transportation options. B. The commercial property's potential for future development and zoning changes. C. The commercial property's historical use and any environmental risks associated with it. D. The commercial property's market value and the sale price of the property. Answer. C. The commercial property's historical use and any environmental risks associated with it. Explanation. In commercial property underwriting, evaluating the property's historical use and any associated environmental risks is crucial. Commercial properties often have complex histories and potential environmental issues that can impact the title and its insurability. Unlike residential properties, commercial properties may have more significant risks related to prior industrial uses, environmental contamination, and zoning changes. Assessing these factors is essential for accurate risk assessment and underwriting decisions. Question 15. Title insurance regulations and compliance. What does the Dodd-Frank Act primarily regulate in the context of title insurance and real estate transactions? A. It establishes requirements for title insurance premiums and fee disclosures. B. It regulates the practices of real estate agents and brokers, including disclosure of conflicts of interest. C. It oversees the implementation of consumer protection standards and transparency in mortgage and settlement processes. D. It sets guidelines for the issuance of title insurance policies and the settlement of claims. Answer. C. It oversees the implementation of consumer protection standards and transparency in mortgage and settlement processes. Explanation. The Dodd-Frank Act focuses on enhancing consumer protection and transparency in the mortgage and settlement processes. It established the Consumer Financial Protection Bureau (CFB) to oversee and enforce regulations related to financial products and services, including those affecting title insurance and real estate transactions. The Act aims to ensure that consumers are well informed and protected from unfair practices in the financial and real estate markets. Question 16. Closing and settlement procedures. What is the purpose of the closing disclosure form and how does it differ from the HUD-1 settlement statement? A. The closing disclosure form provides a detailed breakdown of settlement costs and is used exclusively for FHA loans, while a HUD-1 is used for conventional loans. B. The closing disclosure form is used to summarize the final terms and costs of the mortgage, while the HUD-1 settlement statement details the actual settlement costs for a real estate transaction. C. The closing disclosure form provides a preliminary estimate of costs, whereas the HUD-1 settlement statement is the final document detailing the actual costs at closing. D. The closing disclosure form and the HUD-1 settlement statement are interchangeable and serve the same purpose in documenting settlement costs. Answer. B. The closing disclosure form is used to summarize the final terms and costs of the mortgage, while the HUD-1 settlement statement details the actual settlement costs for a real estate transaction. Explanation. The closing disclosure form is designed to provide a clear summary of the final terms and costs of the mortgage, including loan terms, projected payments, and closing costs. It is required for most residential transactions and replaces the HUD-1 settlement statement for most loans. The HUD-1 settlement statement, on the other hand, was used for detailing actual settlement costs and was specific to transactions involving a federally related mortgage. The closing disclosure aims to enhance transparency and consumer understanding of the final financial terms of the transaction. Question 17. Title insurance underwriting. When assessing the risk of issuing a title insurance policy for a newly constructed property, what is a critical factor that must be evaluated? A. The previous ownership history of the land where the property is built. B. The construction company's reputation and prior construction projects. C. The accuracy and completeness of the property's survey and legal description. D. The anticipated future market value of the property upon completion. Answer: C. The accuracy and completeness of the property's survey and legal description. Explanation: for newly constructed properties, it is critical to evaluate the accuracy and completeness of the property's survey and legal description. This ensures that the property boundaries are correctly established and that there are no encroachments or disputes affecting the title. While the previous ownership history and the reputation of the construction company are important, the primary concern for title insurance underwriting in new construction is verifying that the property's legal description and survey are accurate and complete. Question 18. Ethics and professional responsibility. What is an appropriate action for a title insurance professional who discovers a conflict of interest in a transaction? A. Disregard the conflict if it does not directly impact the transaction outcome. B. Fully disclose the conflict of interest to all parties involved and recuse themselves from the transaction if necessary. C. Continue with the transaction but keep the conflict confidential to avoid any complications. D. Seek permission from their employer to ignore the conflict of interest and proceed with the transaction. Answer: B. Fully disclose the conflict of interest to all parties involved and recuse themselves from the transaction if necessary. Explanation: title insurance professionals must adhere to ethical standards that require full disclosure of any conflicts of interest to all parties involved in the transaction. If the conflict cannot be resolved, the professional should recuse themselves from the transaction to maintain integrity and avoid any potential bias or unfair advantage. Ignoring the conflict or keeping it confidential violates ethical principles and can compromise the fairness of the transaction. Question 19. Title searches and examinations. Question: when examining a title report, what is a key factor that should be verified to ensure that the title is free from significant encumbrances? A. The total number of prior owners listed in the report. B. The presence of any recorded judgments or liens against the property. C. The completeness of the title report, including the number of pages. D. The market value of the property as reported in the title report. Answer: B. The presence of any recorded judgments or liens against the property. Explanation: when assessing the status of a property's title, one of the most critical factors to verify is the presence of any recorded judgments or liens against the property. Judgments and liens are legal claims or encumbrances that can affect the property's marketability and value. They must be resolved before closing to ensure that the title being transferred is clear and free from significant encumbrances that could impact the new owner's rights. The total number of prior owners, the completeness of the report, and the market value are less directly related to determining the title's current encumbrances and its insurability. Question 20. Title insurance policies. What is the primary difference between a standard title insurance policy and an extended coverage policy? A. Standard policies provide coverage only for defects that are apparent from public records, while extended policies cover additional risks such as survey issues and zoning violations. B. Standard policies cover all potential risks regardless of their nature, while extended policies only cover specific risks outlined in the policy. C. Extended coverage policies are less expensive than standard policies due to their broader coverage. D. Standard policies include automatic endorsements for additional coverage, while extended policies require separate endorsement applications. Answer: A. Standard policies provide coverage only for defects that are apparent from public records, while extended policies cover additional risks such as survey issues and zoning violations. Explanation: the primary difference between standard and extended coverage title insurance policies lies in the scope of coverage. Standard policies typically cover risks that are identified through public records, while extended coverage policies offer additional protection for risks not covered by standard policies, such as survey discrepancies, zoning violations, and other matters that may not be apparent from public records alone. Extended policies provide a more comprehensive level of protection, addressing a broader range of potential issues that could affect the title. Question 21. Title insurance regulations and compliance. Under the Real Estate Settlement Procedures Act, RISPA, what is required to be disclosed to the borrower at the time of loan application? A. The estimated cost of title insurance and other settlement services. B. The exact amount of settlement charges, including title insurance premiums. C. A detailed breakdown of the loan's interest rate and payment terms. D. A summary of the lender's policies on dispute resolution and complaints. Answer A. The estimated cost of title insurance and other settlement services. Explanation. RE. SPA requires that borrowers receive a good faith estimate, GA, or more recently a loan estimate, which includes the estimated cost of title insurance and other settlement services. This disclosure helps borrowers understand the costs associated with their loan and settlement process, promoting transparency and allowing for comparison shopping. Exact amounts are detailed in the closing disclosure provided before closing, not at the time of loan application. Question 22. Closing and settlement procedures. What is the primary purpose of a closing protection layer, CPL, in a real estate transaction? A. To guarantee the accuracy of the title insurance policy issued. B. To provide protection against errors or omissions by the title agent during the closing process. C. To ensure that the title company covers all potential claims related to the property. D. To confirm the buyer's and seller's compliance with all contractual obligations. Answer. B. To provide protection against errors or omissions by the title agent during the closing process. Explanation. A closing protection letter, CPL, is issued by the title insurance company to provide protection for the parties involved in a real estate transaction against errors or omissions by the title agent during the closing process. It ensures that the title company will cover any financial losses resulting from such errors or omissions, thereby safeguarding the parties' interests. The CPL does not guarantee the accuracy of the title insurance policy itself or cover all potential claims related to the property. Question 23. Title insurance underwriting. When underwriting a title insurance policy for a property with multiple ownership interests, what is a key consideration? A. The total number of owners involved in the transaction. B. The validity of each owner's claim to the property and their ability to convey clear title. C. The percentage of ownership interest held by each party. D. The history of disputes among the owners regarding property use. Answer. B. The validity of each owner's claim to the property and their ability to convey clear title. Explanation. In underwriting title insurance for a property with multiple ownership interests, the primary consideration is verifying the validity of each owner's claim to the property and their ability to convey clear title. It is essential to ensure that all owners have the legal right to transfer their interests and that there are no conflicts or claims that could affect the title. The total number of owners, their percentage of ownership, and their past disputes are secondary to confirming that each can lawfully convey a clear title. Question 24. Title insurance regulations and compliance. Which federal regulation specifically addresses the disclosure requirements for title insurance premiums? A. The Dodd-Frank Act. B. The Truth in Lending Act, TILA. C. The Real Estate Settlement Procedures Act, RESPAC. D. The Homeownership and Equity Protection Act, HOEPA. Answer. C. The Real Estate Settlement Procedures Act, RESPAC. Explanation. The Real Estate Settlement Procedures Act, RESPAC, specifically addresses disclosure requirements for title insurance premiums and other settlement costs. RE. SPA mandates that borrowers receive a good faith estimate or loan estimate that details the costs associated with title insurance and other settlement services, promoting transparency and helping consumers make informed decisions. The other regulations mentioned focus on different aspects of real estate and lending practices. Question 25. Real property law and legal concepts. What is the effect of an easement on the title of a property? A. An easement transfers ownership rights to the easement holder. B. An easement grants a specific right to use a portion of the property for a particular purpose while retaining ownership. C. An easement has no impact on the property's title and is considered a temporary arrangement. D. An easement can be disregarded if it is not recorded in the public records. Answer. B. An easement grants a specific right to use a portion of the property for a particular purpose while retaining ownership. Explanation. An easement grants a specific right to use a portion of a property for a particular purpose, such as access or utilities, while the ownership of the property remains with the title holder. Easements are considered encumbrances on the title but do not transfer ownership rights. They must be recorded to be enforceable and to inform future buyers of the property. Disregarding an easement or its recording can lead to legal disputes and issues with the property's title. Question 26. Title insurance policies. How does an endorsement modify a standard title insurance policy? A. It increases the coverage limits of the policy. B. It provides additional coverage for specific risks not covered by the standard policy. C. It alters the fundamental terms and conditions of the original policy. D. It replaces the standard policy with a new insurance policy. Answer. B. It provides additional coverage for specific risks not covered by the standard policy. Explanation: an endorsement modifies a standard title insurance policy by adding coverage for specific risks or circumstances not included in the original policy. Endorsements are used to tailor the policy to address particular concerns or requirements of the transaction, such as coverage for zoning violations, survey issues, or other specialized risks. They do not alter the fundamental terms or replace the original policy but enhance its coverage. Question 27. Title insurance underwriting. In title insurance underwriting, what is a crucial factor in assessing the risk associated with a commercial property? A. The commercial property's lease agreements and tenant history. B. The current market conditions and property appreciation trends. C. The potential environmental liabilities and land use history of the property. D. The aesthetics and design features of the commercial property. Answer: C. The potential environmental liabilities and land use history of the property. Explanation: when underwriting a title insurance policy for a commercial property, assessing potential environmental liabilities and the property's land use history is crucial. Commercial properties may have complex histories involving industrial uses or environmental contamination that can impact the title's insurability. Evaluating these factors helps identify risks that may not be apparent through standard title searches and ensures that the policy covers potential issues related to environmental and land use concerns. Question 28. Ethics and professional responsibility. How should a title insurance professional handle confidential information obtained during a transaction? A. Share it with trusted colleagues who are working on the same transaction. B. Disclose it to any interested party to maintain transparency. C. Protect it from unauthorized access and only use it for its intended purpose. D. Store it in a public database for future reference and ease of access. Answer: C. Protect it from unauthorized access and only use it for its intended purpose. Explanation: title insurance professionals must protect confidential information obtained during a transaction by safeguarding it from unauthorized access and using it solely for its intended purpose. Confidentiality is critical in maintaining the privacy and trust of all parties involved in the transaction. Sharing sensitive information with unauthorized individuals or storing it in a public database can lead to breaches of privacy, legal repercussions, and loss of trust. Ensuring that information is handled responsibly is both an ethical obligation and a professional requirement. Question 29. Title searches and examinations. During a title search, what is a common issue that may be identified if there is a missing deed in the chain of title? A. The property's current owner might have misrepresented their ownership status. B. The property may be subject to lien or encumbrance not recorded in the public records. C. The chain of title may be incomplete, leading to potential legal disputes over ownership. D. The property's market value may be affected due to the missing deed. Answer: C. The chain of title may be incomplete, leading to potential legal disputes over ownership. Explanation: a missing deed in the chain of title can result in an incomplete chain of ownership, which is a significant issue during a title search. This incomplete chain can lead to potential legal disputes over ownership as it creates uncertainty about the rightful owner of the property. It is crucial to address such gaps to ensure that the title is clear and to prevent future claims or disputes. While missing deeds can indirectly affect market value and may indicate potential encumbrances, the primary concern is the completeness and accuracy of the chain of title. Question 30. Title insurance regulations and compliance. Which of the following is a primary requirement under the Dodd-Frank Act for title insurance transactions? A. Title insurance premiums must be disclosed within 3 business days of the loan application. B. Title insurance companies must provide a detailed breakdown of all settlement services costs on the closing disclosure. C. Title insurance agents must obtain explicit consent from the borrower for any third-party fees. D. Title insurance policies must cover all potential risks related to the property's value and ownership. Answer: B. Title insurance companies must provide a detailed breakdown of all settlement services costs on the closing disclosure. Explanation: under the Dodd-Frank Act, title insurance companies are required to provide a detailed breakdown of all settlement services costs, including title insurance premiums, on the closing disclosure. This requirement enhances transparency and helps consumers understand and compare the costs associated with their real estate transaction. The closing disclosure must be provided to the borrower at least 3 business days before closing, allowing them to review and confirm the costs. The Act does not mandate explicit consent for third-party fees or require policies to cover all potential risks, but it emphasizes clear disclosure of settlement costs.